So in this video, I want to cover two important parameters that you should focus on if you plan to hold on to a stock for like 6 months, 1 year, or as long as it remains above the blue line or the 50-day simple moving average. So I am basically talking about a positional trade that you have taken in a growth stock which has just broken out of a well-formed base on the right hand side of the chart. Okay. So if I open MarketSmith data for a particular stock, okay, I want to talk about these two parameters, return on equity and cash flow. First, let's look at return on equity. What exactly is return on equity and what should this number be? So MarketSmith, based on their 125 years of stock market research or history, they have found that if the return on equity number is more than 17%, it could be a very good performing, it could prove to be a very good performing growth stocks. Or in other words, most of the growth stocks, if we look at their characteristics before they broke out, most of them showed a return on equity of minimum 17%. And we are talking 125 years of stock market history, which was the study was done by William O'Neill. So after a lot of research, they have come up with that 17% number. So if you go to the MarketSmith website, they will give you the definition of return on equity, and they will also give you the recommendation. So go to MarketSmith, click on product, click on support. Okay, just type, I press Control F. Just here, I will type return on equity. Presented as a percentage figure, it is derived by dividing the annual income. So you take the net income divided by the equity, the current financial year and the previous financial year, take the equity, calculate the average of the equity. That average becomes the denominator. And the numerator becomes the net income. That's your return on equity. That should be 17% minimum. Okay. So as an indicator of a company's financial performance, it measures how efficient a company is with its money. So for every dollar of equity invested in the business, what percent is the company earning back in terms of profit? That's minimum 17% is what is required. The biggest stock market winners historically showed an ROE of 17% to 50% before they made their huge gain. So this before word is very important. So this is what we want. We want to look at stocks which show minimum ROE of 17%. If you are planning to hold it as a positional trade, if you are doing swing trading, then it doesn't carry much weight, because for swing trading, we don't really look at fundamentals. We are mainly looking for strength. We are looking for industry outperformance, stock outperformance, and institutional demand, and stocks which are near 52-week high. But when it comes to positional trading, if I buy a stock, obviously it is going to meet the technical criteria. Obviously, I'm going to buy a stock which is showing strength. But on fundamental level also, if it starts to show strength, like ROE of 17 to 50%, then I might stay in the stock for a longer period of time. So that's this number. So in this stock, let's say Amara Raja, return on equity is not up to the mark, which means I need to stay away from this stock. I can only use this stock for swing trading, not for positional trading. Okay. If you look at some other stock, let's say Dixon, which I looked at recently. See, Dixon is 22%. Okay. This is good. This is more than 17%. So for every dollar of equity invested in this business, it is earning 22% on top of that. Okay. That's as profit. That's called as return on equity. It's basically how efficiently you are using your money, how quickly you are getting your money back, your invested money back. So if I'm putting $1, I'm getting 22 cents back in just 1 year. That's a very powerful rate of return. This is first point. Just remember that this number should be more than 17%. The higher, the better. Now let's come to the cash flow. Cash flow, this number should be positive. That's the most important thing. It doesn't matter what the number is, as long as the number is positive. So first, let's try to understand what is this number. So they write here, cash flow from operations derived by adding depreciation, depletion, amortization. So basically, let me explain what this is. So cash flow from operations means while running the business, how much cash is coming in versus how much cash is going out for business operations. Here we are not looking at investment cash flow or financing cash flow. So if the company is buying a plant on machinery, or the company is buying some land or something, that is not considered in operations, because that is like buying an asset. It's like making an investment. Or if you have financing cash flow, like companies giving dividends or companies raising money by borrowing money, okay, that is not operational cash flow, that is financing cash flow. Operation means actual buying and selling of the inventory, okay, actual business, delivering the service, earning cash, and then spending that money on selling general and administrative expenses, maybe research and development cost, things like that, okay, the actual money that is used to run the business. So every business will have operations, and every operating business will have cash inflow and outflow. So basically what this means is that the inflow should be more than the outflow, because if the outflow is more than the inflow, that means the company is spending more money than it is earning. So if the company is earning, let's say company is generating a cash flow of, let's say, $10 million inflow, and it is spending $20 million, so where is that extra 10 million coming from? It is coming from borrowing, right, which is not a good sign. So basically this number should be positive, okay. So if you go here, it's a positive number, and it is cash flow from operation, the total cash flow, inflow minus outflow, divided by the number of shares. So this is cash flow from operations of the business per share, okay. Now here it is 121. Now imagine a company with a cash flow of 131. Now, does that mean that company is better than this company? No, because the company that has cash flow per share of 131 could be having a lesser number of shares on the same amount of profit, right? So that is why I said, if a number is more than this, doesn't mean that this company is inferior, okay. The only thing we need to ensure is that this number is positive. It doesn't matter what the number is, as long as it is positive. This number could be 25, 35, that is fine for me, because the number of shares could be more. That is why the denominator is large. That is why the ratio is coming down. For me, the important thing is that number should be positive. So remember, cash flow per share should be positive, return on equity should be 17%. These two factors, if they are in your favor, you are looking at a potentially big winner, okay. You don't sell all the shares of the stock too quickly. Please give it some time. Next, for those of you who don't have MarketSmith, go to this trading view, click here, click on financials, okay. On financials, for return on equity, go to statistics and click annual. Now when you come down, you see return on equity here 24%, okay. There it was given 22, maybe it's last year, but it's more than 17%, okay. So trading view gives you all the data. Then comes cash flow from operations. So again, you go to statements, you click on cash flow, see income statement, balance sheet, cash flow, click on cash flow, see cash flow from operating activities, click on annual, the latest year, okay. This number should be positive. That's it. Now this is not per share, but whatever number of shares you divide it with, it is going to be a positive number, right? If the number itself is positive, because the number of shares is never negative, okay. So remember the rule. The best growth stocks of the past had minimum return on equity of 17% before they made their strongest moves. Plus, the cash flow from operation should be positive. We should not put money in a company where it is losing money in operations. Okay, if the company is losing money in operations, then it will have to do financing. It will have to keep borrowing money to finance its operations. That is not a great company. Okay, we want a company that is or get earning so much cash that it doesn't know what to do with the cash. Okay, that's the kind of company that we want to get involved in. Okay, so return on equity, cash flow, very important points. So please don't forget to like, comment, and share this video so that this little pieces of little pieces of advice or little pieces of information reaches those professional stock traders who are trying to improve their performance. So please help me take this video to as many people as you can. Please like, comment, and share this video so that we help other fellow traders as well. Thank you so much.